Welcome to my channel. I'm the Covered Call guy, and this is my journey to creating a $120,000 per year passive income portfolio. My portfolio currently yields about 70,000, just about $6,000 a month, and I will be reaching my goal using strictly Covered Call ETFs. And when I reach my goal, comment, let me know, or before I reach my goal, comment, let me know what I should get into, what ETFs. It could be anything. Cover call ETFs, single, regular ETFs, single stock. I'm open-minded to everything. Maybe introduce me to something new, possibly, right? So before we get started, legal disclaimer: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Always do your own research and consult a licensed professional before making financial decisions, okay? I am just some random idiot you found online, and I can be completely wrong. All right, with that out the way, today's video is gonna be about the passive income myths. I get a lot of a lot of how can I say, from other people that know what I'm doing, and they always talk about the passive income, how easy it is, and I want to debunk that, right? Passive income, and there's a whole bunch of ways that you can make passive income. I've done real estate investing, and for sure dividend investing is much more passive. It is probably one of the true passive um income that you can definitely that's out of everything you can do, right? I mean, um real estate is probably one of the hardest for passive income. Anyways, I digress. Before I spiel about other stuff, let me start on this video. It's gonna be a short video. The Active Investor's Guide to Passive Income, right? Debunking myths and understanding the risk of covered call ETFs for passive income. Right, myth versus reality, the passive income premise, right? The myth is that it's effortless mailbox money, right? The money just every week or every month you get the mailbox check directly deposited, aka your brokerage, right? Passive income is a mailbox money that generates wealth on its own, right? This is the belief that one can buy an asset, do nothing, collect a check forever without any risk or ongoing effort. The high yield is often mistaken for a guaranteed profit, right? So a lot of people think, oh, it's passive, it's easy, set and forget, right? There are different cover call ETFs that are more set and forget than others. But remember, it's not truly passive. You still have to stay on top of your game, right? It's much better than owning real estate, because real estate, your tenant can call you at 2 a.m., 3 a.m., once a week, once a month, and be like, hey, something broke. That is your responsibility, right? You're spending a lot of money. You have to do a lot to get a good tenant, and then something can go wrong with the house, and that's your responsibility. So a lot of things can happen. Whereas, stocks, then they'll never call me at 3 a.m., 4 a.m., 5 a.m., hey, saying this happened, this broke, toilet's clogged, or your tenant can lose the job and you might not have rent coming in. So stocks won't do that to me. All right, so that's why I think stocks are the most passive, but it is not 100% passive. It's not 100% true passive. You still have to do your work. You still have to put in work into it, right? There are more set and forget, but remember, it's not just buy it and let it make money without having to ever check on it, right? That's the reality, right? Active due diligence. Sustainable income requires active due diligence, risk management, and understanding that yield is not the same as profit. Significant initial research is required to select the right strategy. Ongoing management and portfolio monitoring are essential, right? That's the big part of not being passive. Yes, it's much easier. There's no hard labor, right? For the most part, you have to stay on top of the news. That is time consuming. Of course, you're stuck to your phone or the TV a lot, or the computer. That is the work, right? I mean, it's nothing crazy, but you do have to monitor current events. You do have to see what's going on. Did the fund change, right? You have to stay on top of the game. So it's not as passive as one think it is, right? Income is variable and is not guaranteed. So that's one thing you have to stay on top of, right? That's what not makes it true passive. You have to stay on top of it because things change on the dime, right? Investors are still exposed to market and strategy specific risk. Right? How does a traditional covered call ETF actually work? Right? So for the newbies, for the new viewers, welcome. For the people that are thinking about getting into covered call ETFs, welcome. For those who have bought covered call ETFs and still want to get a little the knowledge up on working on it, welcome. Right? So one, the ETF buy the stocks, the fund buy basket of stocks such as the S&P 500 or custom selected portfolio. Then they sell call options, right? It sells the contracts, the call options, giving someone the right to buy these stocks at a set strike price by a future expiration date. And by selling the call options, you collect that premium, right? For selling this contract, the fund is paid an option premium immediately, right? This premium, cash, is the primary source of the high distribution, right? And it distribute the money to you, right? At expiration, if the stock is below the strike price, option expired worthless, the fund keeps the premium plus the stock, right? If the stock is above the strike price, the stock is then called away, aka sold. The fund keeps the premium, but its profit is capped at the strike price. And that's, in simple terms, how it works. All right, a deep dive for the income investor, right? The passive income investor like myself, and for those who are watching, possibly for you too. Understanding these investment means asking the right questions, right? This section group this sections the group of critical questions into themes or analysis. So I like to ask questions about the stock / ETF that I buy, right? What is this income, right? Not all distribution or created equal. The income received can be a mix of option premiums, stock dividends, and even ROC, which is return on capital, which has significant tax implications, right? So this is just a example. I don't think I've used a stock for it or ETF for it. I just want to give a visualization. This video is not going to be in depth. It's just this video is just going to be short and clean, and it's just letting the viewers and especially the newbies, if you're watching this video, just know where the income is coming from, right? You should always understand how a covered call ETF is making their money, right? Key takeaway: it's critical to check the tax implications because you want to keep more of your money, right? I like to keep more of my money. I want to keep all my money. Why would you want to have Uncle Sam take your money? If you don't want your money, give it to me. Right, qualified dividends have lower tax rate. Option premiums are often taxed at a higher rate. Ordinary income, such as ordinary income or short-term gains. Right, return on capital. ROC isn't a profit. Is the funds returning an investor's own money, which defer taxes but creates a larger capital gain upon sale. And then again, distribution frequency. How often does it distribute money, right? Like these covered call such as JEPI, DIVO, FEPI, TSOY, TLTW, right? They all paid 12 times, which is once a month, right? Compare that to SCHD, which is a quarterly, so it pays 4 times a year, right? This chart just shows distribution per year. Most income ETFs, equity-based like FEPI or bond-based like TLTW, pays monthly. To attract income investors. This contrasts with standard dividends ETFs like SDHD show a quarterly reference that typically pay quarterly, right? Not stock recommendations, just examples. Right, so strategy, sacrifice, and risk, right? You got to ask these questions. What is the strategy behind the covered calls? What am I sacrificing? What is the risk, right? So start, right? So this chart visualized the upside cap in a strong bull market. The S&P, which is the blue line, pulls away, while the covered call ETF gray dash lagged because its gains are capped. This is the core trade-off, right? An investor is paid a premium to sell their upside potential. All right, and the strategy, sacrifice and risk. I just list a few covered call ETFs. Again, not stock recommendations. I just like to put random covered call ETFs. So I'm not here to be biased. I just want to let everybody see it, right? So you can pause this and read it. I'll just read the key takeaway. Strategies range from diversified JEPI to highly concentrated FEPI or DIVO to extreme to like TSLY. A single stock ETF carries immense undiversified risk, right? Passive funds like QYLD will always cap gains, while tax managed funds like SPY try to optimize after tax returns. So you have to figure out what is the best for you, and what is your lifestyle going to be, and how you want to um, play your passive income, right? How the passive income is going to affect your lifestyle. If you don't mind the taxes, if you want to hold the covered call ETFs because you like the strategy, but you're paying a little bit more taxes. Again, personal preference. It's just something you have to think about. And then the market condition and performance, right? How will market conditions affect my covered call ETFs performance, right? These ETF are not magic, right? They're not as everybody think, oh my god, just buy it easy, set and forget, right? Some covered call ETFs are more passive set and forget than others, right? Again, you have to pick the right covered call ETFs that fits that strategy, right? Their performance is directly tied to the market volatility, interest rate, and economic cycles, right? High volatility means higher premiums, but also means higher risk. And this chart just illustrates the VIX, right? Which is market volatility, right? VIX is the feel for option premium when market are chaotic and fearful, which is high VIX. Premium rises, increasing the ETF's income. When market are calm, low VIX, premium falls, reducing the income. That's simple. And then how does performance by market, right? You have to look at the strategy, the under the hood, like I like to call it, behind the cover call ETFs. And you can pause this and read this. I'll just read the key takeaway, right? These funds are defensive tools. They are built to shine in flat or slightly down markets. They will always lag in a strong bull market and will still lose money in a sharp bear market, just potentially less than the index. Because of the option premiums, it acts as a buffer. Right, and then investors due diligence checklist, you got to ask yourself, right? Always look at the expense ratio, check the fees, right? Because at the end of the day, if it's high, you are losing more money if the cover call ETF does not perform, right? Analyze NAV erosion. We don't want the NAV to be shrinking over time, right? So then that is a bad block, right? We want good block. That means they are distributing much larger income than is being generated, and the investor is in effect being paid their own money. Nope, that's a big red flag, right? We don't want that. And always read the perspective, right? It's literally telling you what the fund is going to do, right? Is the strategy active like DIVO or passive like QYLD, right? A passive fund must sell calls even in a bull market. An active one can be more selective, right? Always read the perspective of your cover call ETFs. That's like probably the first thing you should do. Because they're laying out the game plan to you, and they're telling you directly, hey, this is what we're gonna do, or this is what we try to do. And then you assess the portfolio fit, right? How does this fit your goal, or are you building wealth growth or paying bills, right? These funds are to be distributed, not for long-term growth. Again, depends on what cover call ETFs you pick, right? Some cover call ETF does have growth. QDVO, for example, and DIVO, yeah. So listed here, DIVO from Amplified. So yeah, it just depends. Yeah, you have to fit your portfolio need. And then income tool. Income is a tool, not a guarantee, right? So cover call ETFs are powerful tools for investors who knowingly prioritize current cash flow over capital appreciation, right? They are not passive, they are not risk-free, and they are not get-rich schemes. They are an active strategy choice that requires understanding the trade-off, which is the cap upside. You should always be monitoring the risk of NAV erosion and accepting that the income will underperform in a strong bull market, right? Capped upside. By asking these critical questions, an investor can move from a passive recipient to an active informer, right? You always ask yourself, right? Where do I want to see myself in 1, 3, 5, 10 years? How do I get there? And then when I get there, how do I maintain 15, no, year 15, year 20, right? And then when I'm finally ready to pass on my stocks, if you have kids, right? How do I do that? What cover call ETFs fit the narrative for me. So you have to ask the right question. Just don't look at how much is paying. Don't look at how much the yield is. Don't look at the current uh um structure and environment. You have to look at the whole. Will it actually is it actually structurally sound? Is it sound? Does the active management, do they think long term, right? These are a lot of things you have to think about. That's why it's not true passive. um I don't like how they call it all passive income. Yes, it's more passive than some, um but there is a lot of work behind the scenes. So just like how I'm doing my due diligence on every ETF that I pick, you know, that's not really passive. I'm spending a lot of time, and then that's just the first part. Then I buy the ETF, and then I have to do more work every single day, every single week, every single month. So welcome to the passive income investing world for those who are new. I hope you guys enjoyed the video. Hope you guys learned something. This video was inspired by a friend of mine. We were just talking about passive income and how easy it is, and I just thought, nah, not really. But um, comment, subscribe, like, and thank you for watching the video. Thank you for supporting me in my journey, and see you guys on the next.